The announcement on Sunday that UBS has agreed to buy its longtime rival Credit Suisse has shocked the financial world. The deal, which sees the Swiss regulators and Swiss National Bank playing a key role, is worth $3.2 billion, which is an 80% discount to Credit Suisse's Friday close in market cap. The two key questions investors have in mind now: does this deal have broader ramifications on the equity markets, and how will the Federal Reserve respond at this week's meeting? Joining us to discuss these issues and more is Ted Oakley, founder of Oxbow Advisors. Ted, it's good to see you again. Welcome to my new show.
David, glad to be here. I know you'll be successful as you always are.
Thank you very much. Let's talk about recent activity regarding the S&P 500. The stock markets this morning, as of Monday, March 20th, around noon Eastern time, reacted quite positively to the news that Credit Suisse will be bought out for $3.2 billion. Exactly what does the market think of this deal?
Well, it looks like, just from the outside looking in, that they think that that's going to settle down, most of these problems they've had in the banking system, and that seems to be what's coming out of all this. We don't own the banks. We own a couple of the preferreds in the too big to fail banks, but not much. We never have much in the banks.
Okay. Well, the Federal Reserve is meeting this week, Ted, and everyone's wondering what they're about to do and how they're going to respond to not just this week's news regarding Credit Suisse, but also the fallout regarding regional banks, and I'm referring to SVB, Silicon Valley Bank. Now, I'm looking at the CME FedWatch tool, which tracks the probability of a Fed rate hike, and it seems that market participants are pricing in of 25 basis point hike. As of noon on Monday, we're looking at a 77.5% chance of a 25 basis point hike versus a 22% chance of no increase at all. I've been hearing rhetoric that the Fed is likely to make a tactical pause or a strategic pause in light of what's going on. What are your expectations, Ted?
Well, David, I really don't have any. It's such a one of those things where I don't think anybody would have an idea, but the one thing that does lurk out there is this: if Powell is going by his data dependent stuff, then he needs to go ahead and raise it a quarter. Now, I suppose he could say, or the committee could say, hey, we do it in light of what's going on in the banking system. We're going to wait a little while, but I think that goes back into the category where he's trying to get away from, where the Fed has a big impact on the stock market. We'll see how it goes, but let's face it, a quarter of a point here wouldn't hurt anything, wouldn't help anything, really. I mean, I don't think that's something that would be a deal breaker any worse than things already broken.
I remember, Ted, a week and a half ago, nearly 2 weeks ago, there was a higher probability of a 50 basis point hike. It seems that probability has been more or less priced out of market expectations. What changed over the last 2 weeks?
Well, I think anytime the government sees that, hey, we've got some shakiness in the system, that they want to settle that down a bit, and I think that's the take. They want to settle it a bit, and that's just all you can say from that.
Let's take a look at how the S&P 500 has performed over the last, I would say, few months. Now, since the last quarter of 2022, we've been more or less on an uptrend. Now, recently, news have been coming out of the financial system that things are, in your words, a little bit shaky. Give us your medium-term projection. I know we've spoken in the past, and you projected more downside. Do you think that more downside now is a certainty given what's happened, or are you changing your tune?
No, David, we're still on the same path. I mean, I think people forget that when you come off of these super bubbles, and that would be like 2021, year 2000, 1929, maybe Japan in 1989, those super bubbles, when everything got too expensive and really, really got crazy, it takes a long time to wring that out. You can't just do it overnight. It's not one of those just sort of short-term bear markets. So we feel like that you're not even to this point yet to where the earnings are showing up. Now that's coming next, where the earnings are going to be down. And then all of a sudden, the last thing to go is where unemployment rises. And when you look ahead and you look at those two things, I'll give you an example. If you just look at the price to sales ratio on the S&P 500 today, it's still about 2.1 times. It was up 3.3 times. Well, 2.1 is where the peak of the dot-com bubble was. So we're not anywhere close to being, in value territory at this point, and we're looking for lower earnings than most people are this year on the S&P 500. So no, we feel like, I don't know how it plays out. It may all come sooner or later, but we just think that's a longer term thing where the market really eventually goes lower.
Okay, how much lower, Ted? You're looking at a price to sales ratio of what level would be appropriate to you before that ratio contracts sufficiently?
Well, you'd like to see that at a 1.3 to 1.5, but I think in a broader sense, so David, if you look, the street has estimates, and they're coming down, don't get me wrong, but they're still around 215 to 220 probably on the S&P earnings this year. We think they're more like, 185 or 190. And so normally, let's just say you put a 15 multiple on that, you're looking at 3,000, 2,800 to 3,000 on the S&P. I would tell you this, we're not really market timers, but we are value timers. And so we look for a value in companies. If we had value today, we would buy them, but really, we just don't have the numbers that allow us to say, okay, all of these companies are cheap and we want to buy them. And so I'm just using an average multiple on average earnings. It's not something special, but that certainly looks what it looks like to us is the potential.
Overseas in Switzerland, the Swiss National Bank has more or less orchestrated this merger and has pledged capital to support the banks. Basically a bailout, Ted. Now, Janet Yellen, Secretary of the Treasury, has made a statement today, and she said that the capital and liquidity positions of the U.S. banking system are strong, and the U.S. financial system is resilient. We have been in close contact with our international counterparts to support their implementation. Do you agree, Ted, that the capital and liquidity positions of the U.S. financial sector are strong right now?
Well, I think they're much better than they were back in 07 and 08. I do think that, David, but, banks are only as good as people have faith in them. And I don't think their faith is waning that much. I mean, I don't see big deposits leaving the community banks. So I think in that respect, she's probably correct. But you have to wonder about this on the bailout of Credit Suisse. How about all of those tier one convertible bonds that are going to get zero? And so it'll be a long time before anybody issues some sub debt on banks, probably. That's going to have an impact, I think. But we'll see how it pans out. But I think generally people still have faith in the banks. I mean, they've been moving around a lot because of interest rates, I think, more than worrying about the banks.
I know you said you don't owe the banks, but I've been hearing on the radio some investors taking contrarian positions right now and buying in. Let me make you an investment case for buying into the banks right now, and please feel free to disagree with me if you don't want to take this stance. I'm looking at, first of all, the XLF, which is the Financial Sector's Spider Fund ETF. Now, as of about a month ago, prior to March 3rd, it was trading at $35, $36 a share. It's currently at $31. So a big decline following news of SVB and, of course, now Credit Suisse. We're looking at actually capital flowing, depositors taking money out of regional banks and putting it into the larger banks because of, like you said, erosion of trust in the regional banks. And so when you combine the fact that valuations have dropped dramatically and potentially we're seeing more interest or deposits into the larger banks, could that make an investment case to buy the financial sector, the larger banks, Ted?
Well, I think the problem, David, is that where you are in the cycle. I mean, but banks, you have to realize that in one respect, the worst is still in front of them. Just think about commercial real estate. They're all loaded up. I don't care if it's a big bank or a regional community bank. They're all loaded up with commercial real estate, big time. And so that's a lagging piece that falls off in the economy, real estate. Now, it's held up in here. I have a reason for it. But I think what's going to happen is they have to deal with commercial real estate, which that's coming up in front of them. And then they're going to have loan delinquencies because you go into recession. And it just that you don't own these, you normally don't want to own the banks when you're leading into a recession. You want to own them when you're coming out on the other side at some point. And I just don't think you're at that part of the cycle now where you want to own the banks.
Which part of the cycle exactly do you want to be then, Ted, before you own anything like the banks?
Well, I think at this stage of the cycle, I mean, just for us, for example, all three of our strategies, they all have about 60% treasuries. And we've been making 4.5% to 5% on treasuries less than 2 years. So that's been a good place for us to park. And if you think about it, just on a projected basis, the treasuries probably, the long bond has probably made a little more this year than other things. I think, the S&P, I'm not certain, it's up a few points, the Dow's down a few points. But generally, just go back to when all this started, January 1 of 2022, we're still in a bear market. And we're 15 months into it, too. And I think people forget, they want it to work. I understand they want that. But in these big super blowouts that we had like that, when you have a bubble like that, you're going to have these places where people come in and try to catch it. But they don't work, they fade.
It's interesting, just going back to the valuations, it's interesting earlier in the interview you referred to the markets as being in a bubble. Is that true even despite the big downturn we saw last year in 2022? Are we still in a bubble despite the drop in valuations?
Well, we're working it off right now. If you think about 2021, there was not one thing other than maybe gold that wasn't in an incredible overpriced area. I'm talking about maybe a 3 standard deviation area, and it included real estate, land, businesses, art, stocks, bonds. It didn't make any difference what it was. And when you get like that and you get all of that money flowing and throwing at things, it takes a long time to really squeeze it out. And I think that's where we are now. And people that have liquidity, I really believe over the next 12 to 18 months, will really get a chance to really make some money. I mean, I think there will be some great opportunities, but you have to wait it out because at this stage, you're sort of right in the middle of the pain. And I think buying into this will not do you any good.
Oh, I'm going to press you on that, Ted. Buying opportunities over the next 12 to 18 months, where are these pockets of opportunities in the markets?
Well, David, let's just say you go back to a 15 multiple on 185, 190 earnings in the S&P. You're going to have a lot of companies then that are going to be in that area where if you screen them out, are going to be cheap relative to where they've been, the last 5 to 7 years. And I could pick and choose, but usually when you're coming out on the other side, you can buy almost anything off of low in a bear market, and people don't realize the first year off a bear market low, especially these big bear market lows, are where you really get a big move in the markets, and things are so cheap that it naturally works that way. But we just don't see it now. We just don't see things that we say this is incredible value right now.
All throughout basically last year, I've been hearing the rhetoric that the Federal Reserve will continue to raise interest rates until something breaks. Has something broken already? I mean, specific companies have broken. I think you know which ones I'm talking about. But broadly speaking, the economy, has it broken yet?
Not really. You think about it right now, where unemployment is, has not started right, maybe a tiny bit. You look at housing, and I think there's a reason housing hasn't broken as much as it has, because if you have a 3% mortgage and now it's a 6% mortgage, you hold off on selling that home as long as you can, because you're going to have to go to, but eventually it comes around because you have to move for business reasons or whatever. And that's when you start to get supply on the market. And people keep talking about, well, the price is not going down because we don't have a supply. Well, there's a reason for it. And nobody's moving it around right now. They don't want to, but they will eventually. And that's when the supply comes and you'll get the break. That's one side. Housing's a big deal. It's well overpriced. Secondly, you're going to have, like I say, your unemployment will eventually rise, but it's usually the very last thing. You really wait to lay off your best people. I think that's coming. I think the earnings are coming. All of that fits together to something where we'll see, some really pretty good prices on some things.
Okay, so you're saying that the economy will deteriorate at some point. It's just that right now it's not at a point that's bad enough for us to really, really worry. But I guess your outlook on the economy long term is aligned with your outlook on the stock markets long term. They're both going down. Whereas your outlook on the stock markets due primarily to valuations that were pushed up during 2021?
Well, I think too, David, people, they've tried to discount the inverted yield curve, but when you get a curve inverted as much as this curve has been, you go into recession. I mean, it'll be the first time we did not. And they can talk about no landing or soft landing, all that stuff. It's almost impossible now not to have a pretty good recession. And I think people that are, they're hoping it's not that way, because got to remember, all these people in the business right now have only been around for 10 or 12 years, and that's all they've ever known. And so they can't ever see the depths of something like that.
The gold market has been on a tear over the last week and a half. Is it telepathing something?
Well, it's interesting. Normally gold will do okay during these periods, because when you get a rise in real rates, I mean, it's going to come around. It's interesting because we watch gold, we own gold, and then we own some of the gold miners too. But normally, interesting enough, the bullion does better than the miners during this period, in my opinion, anyway. Because when you get into these major sell-offs, sometimes people will sell everything they own just to raise cash, but the bullion will hold its own. And so we'll see what happens. But I think it's an okay spot right now for sure.
Okay, I want to talk about your asset allocation and finally Oxbow's positioning right now. But to get into that, let's set the stage for our viewers. You've survived multiple recessions and multiple bear markets, and you're still around, Ted. So tell us about some of the, not just lessons you've learned, but mistakes that you've seen other people make during a bear market or perhaps going into a recession that you wouldn't want to repeat this time around.
Well, one of the things I learned early on, really, and mistakes I made were looking at companies that were pretty good companies, and they would start selling off, and when you're going into a bear market, and maybe sell off okay, and you forget, I'm buying a good company, but am I getting a good price? See, and I think that throws a lot of people if they've never been through bear markets before, because they don't realize how low these companies can go. It's not saying they're not a good company. It's just saying that they're not priced correctly. And that's the difference. You want to buy things that are priced correctly. And when you don't have as much experience, you think, well, it's sold off 25%, so it's got to be cheap now, right? Well, what you don't realize is it may be going down 50, 60, 70%. And so it didn't do you any good. See, it kind of throws you a loop. I think people have to realize that when you go through these periods, and you can talk about hedging and this kind of company will do better and that kind of company, but the main thing that does well in sell-offs is cash. And for us, that's treasuries, but we don't keep it in just cash, but we keep it in really short-term paper, U.S. treasuries, and that's the way you overcome it. You keep enough liquidity so that you can't really be beaten up so badly that you can't come out of it. Because what you want to do on the other side of these is you want to go to new highs. The only way you can go to new highs is you have liquidity, so you can own things cheaper, and then you come right out of that, and that's what makes the big difference.
One of the first things I've been taught when I worked at a macro research shop straight out of college was that valuation is possibly the worst indicator of price direction. And so, we're trained in school to value a stock, and yet when we come out of school, we learn that valuations are completely useless when you're trying to predict whether or not, or decide whether or not to buy or sell. And so if valuations aren't a good indicator for timing the markets, what is then, Ted?
Well, for us, it is something we use, though. We use it. I think when you're referring to valuations, you're talking about it in general. One of the problems this market had, though, David, was we had so many companies. Look at the Russell 3000. So many companies that weren't making any money. They didn't have any revenues. That came out of this big super bubble where they brought all these companies out, SPACs, all this sort of thing. They had no business, selling anything to anybody. And see, that's still off. That's still getting wrung out there right now. So it's a different time. We had so much speculation that you have to wring that out of it. And yeah, I mean, I think it's right. You can look at something that, again, you might look at it and say, well, it's a good value because it's down 35%, but it may be going down another 25. And I think that's part of what happens for us when we get a company we really like. We scale into it. We'll buy 1%, and next time we might go a little lower. We might buy another 0.5%. You have to protect capital, and that's really the way you do it.
What is your view on the U.S. dollar? We've been seeing the DXY hit strength after strength relative to other currencies abroad. Now, domestically, obviously, we have an inflation problem where we had an inflation problem. Inflation's been coming down, but people are now speculating that the dollar will weaken because erosion of faith in the U.S. dollar will make a lot of capital drive out of the country into foreign currencies. What's your view?
Well, normally when you're raising rates, the dollar will stay fairly strong, David, normally. And I think short term, that's probably correct. I do think something you have to look at over the next 3-5 years, though, is where you've had this cross-border finance going on, and they're putting this together, with Russia and China, Saudi Arabia, India, Turkey, countries in South America. They are trying their best to work a system to where they'll have another currency to trade world currency in. And I think they'll eventually get there, which will not be good for the dollar, but that's a longer term thing. They're not there yet, but I think they're working on it.
Okay, finally, let's put everything together and talk about your strategy, given everything we discussed.
Well, we have, like I say, 3 strategies. We have a full stock strategy, and then on the other side, we have what we call a conservative fixed income that's really conservative. Not all the portfolio, but a lot of it's less than 48 months, and we're very, very high quality. And then we have a middle strategy that's called a high income strategy. It does not have bonds in it particularly, but it has other things that pay a lot of cash flow. All of the strategies right now have about 60% roughly, and some a little more, some a little less than the other, and really short-term treasuries. By that, I mean less than 2 years. And we have a lot of variable rate treasuries in there, so we can participate either way. What we do in the conservative side, though, and I think people need to realize that there's a spot in here where you want to shift out and own some of the long paper. Here's why. If you are looking at, say, a 20-year or 25-year or 30-year treasury, let's just say it's yielding 360, and you think that the inflation rates are really eventually going to get down to 2.5% or 2%, that makes that a good buy, okay? So you have to shift some money there as you go through the system in the conservative side. On the stock side, we just don't have if we had the companies, then we bought a few things, bought a little bit of Centene. We bought, in the high income accounts, we just bought a 1% position in Verizon. We set these levels. And so when we had it already set up so that if Verizon hit 7% dividend, we'd buy it. So we bought 1%, not that we wouldn't buy more of it. Kinder Morgan was another one we set in the high income. When it hits that level, we're going to buy it. We bought 1% of Kinder Morgan, all this in the last 3 weeks. But just generally, we know where we want to own things. We're just not there right now. And I think the cash it really served us well in 22, and so far has really served us well in 23.
Now, do you think that bonds are about to make a comeback? We saw in 2022 the failure of the 60-40 portfolio strategy as both asset classes, equities and bonds, took a hit. Perhaps this year, with interest rates rising, bonds are looking more favorable. What do you think?
Well, David, back in 21, I wrote a piece called "There Is No 40." And what I meant by that was you were only getting 1/4 point on the bond. So it obviously was not going to work. There's no 40. Now, though, it's probably going to come back into vogue. And by the time it does, everybody will, they'll be clamoring probably. But they'll miss the point of trying to find really some good yields, you know, before the Fed finally finishes. So you have to look around and look at that. I mean, I think there'll be some really great places. If you look at municipals, there's some great yields on the short and the long term. There have been, and same way with the Treasury. And I don't see any reason to buy the corporates because there's not enough spread over the Treasury, really. And people remember, you know, the Treasury, you don't pay any state tax. So there's all kinds of things go into reasoning to go that direction of the bonds. But I think you have to start slipping in some longer paper as you move along.
Final question, Ted. I know that your fund is already invested, but suppose you were to start a new fund completely from scratch. Let's say you had $100,000 of AUM for this particular fund, and you wanted to do something with it. Number one question, would you deploy any capital at all at this time? That's your first option, to stay 100% in cash. Or B, if you were to deploy, would you use the exact same strategy as your other funds for this $100,000?
You know, to answer that question, David, we probably would, your latter, we probably would take all three of the strategies we have now and just combine them into that, which would mean that a couple of things. We would be buying treasuries, but we'd also be buying some high-grade munis. You'd see us maybe start to step out on the yield curve. Secondly, you'd see us buy, you know, we'll own some common stocks, and not that we don't own any, but we don't own as many as we normally do. So we'll put the ones that we think are still valued correctly in there. And then you'll see us put some high income items in there, especially when you get into an area where you're doing, you know, 6.5%, 7.5% common stock dividends. Well, that's an area you need to take a look at, because what happens is, you know, if you remember, that's a 20% cap on the income tax side plus the 3.8% Obama tax, but still that's a lot better than paying 37.5% plus state tax on something.
All right. Well, we'll come back to that another time. Ted, I appreciate your insights. Thanks for breaking down the markets with us today.
You bet, David. Thank you.
And thank you for watching. Stay tuned and don't forget to subscribe.